Hey rich girls, Kirby here. And have you heard the terms standard deduction and itemized deduction, but never really understood what they meant? Well, today we are breaking down the difference between standard and itemized deductions and how you can determine which one you should be taking. I promise it's not as complicated as it sounds. So let's get this explained and get you on your way within the next 5 minutes, okay? First up, we have the standard deduction. A deduction of any kind is literally just money that is subtracted from your taxable income. Things like health insurance costs through your employer, pre-tax 401k contributions, and the like. Think of the standard deduction as the government's way of giving everyone who owes taxes a bit of a tax break. For tax year 2024, the standard deduction is $14,600 for those that are single or married filing separately, and $29,200 for married filing jointly. What does that actually mean? Let's take a look at an example of a married couple. They each have a salary job of $50,000. Now, they also contribute a bit to their retirement plans through work, and they have Social Security and healthcare costs taken out of their paycheck. So even though they are salaried at $50,000, let's say their 2024 W-2, the tax document that their employer gives them at the end of the year, shows taxable income of $40,000 each. So between the two of them, they have $80,000 of federally taxable income, assuming they have no other income sources and they didn't take any withdrawals from their retirement accounts. And here is where the standard deduction comes into play. Since they are married, they get to deduct $29,200 from their $80,000 of income, leaving them with $50,800 of federally taxable income. Just as an aside, real quick, the standard deduction has been around since 1944. Prior to World War II, most Americans actually did not pay income tax. It was mostly a tax on the wealthiest Americans. But with the war came a lot of expenses, and thus the income tax became a requirement for all working Americans. Itemizing expenses was proving to be a hassle for taxpayers to keep track of and for the government to weed through, which led to a blanket percentage deduction as opposed to a hard dollar deduction in 1944. I'll drop a link below with the full history because it's actually quite interesting. Anyways, the standard deduction is pretty simple. It's just a hard dollar amount that is subtracted from your income, which in turn lowers your overall tax liability. So if this is so simple, why would anyone opt for the itemized deduction? If you have enough expenses that qualify as itemized, and we'll go over what that means in a second, then you may be able to deduct more than the standard deduction from your taxable income, aka pay less in taxes. For our married couple, that means they will have to have itemized expenses greater than $29,200 in order for it to make sense for them to itemize. Sound like a lot of expenses? That's because it is. Only about 10% of taxpayers chose to take itemized deductions in 2020. Have you ever heard of certain high-income celebrity figures that make crazy amounts of money but reportedly pay little to no taxes year over year? Well, that is in large part due to itemized deductions. This is typically something that is used by wealthier, high-income individuals that think about taxes all year long and pay tax professionals to help them implement tax strategies that will reduce their overall tax bill, while still, of course, benefiting them in the long run. I used to see this all the time in wealth management, and I will just tell you firsthand, the wealthiest Americans, for the most part, not everyone, but most of them, do not care about helping people through charitable donations or throwing galas to raise money for children with cancer. Every investment decision that they make is made through the lens of paying less tax, boosting their public image, getting in front of potential clients or business partners, or hitting all three if they can swing it. It's honestly exhausting, and I do not envy those that feel like they have to make every single life decision through that lens. So what exactly can be included as an itemized expense? Here are the heavy hitters that most of us look at first when crunching the numbers. Interest paid on your home mortgage, charitable donations, property taxes if you live in an area with high property tax, and medical expenses, depending on how much you paid out of pocket compared to your income. Now, there are other expenses that do qualify to be itemized. I'll drop a link below with all that information, but those are the main four that you are going to want to look at and take into account when making your decision as to whether or not to itemize. Okay, so let's go back to our married couple and see if they have enough qualifying expenses that will make sense for them to choose itemized deductions. Let's say they just bought a house a few years ago and have a 30-year mortgage. Since they are still in the early years of paying off that mortgage, their monthly payment is going to be mostly made up of interest. So let's say on a $300,000 mortgage, they pay about $850 in interest every single month. So we're going to multiply that by 12, and that means they have a roughly $10,200 of deductible interest. Let's also say that they live in a place where property taxes are fairly high, let's say 1%. So that's another $3,000 that is deductible, assuming their home value is $300,000. This now brings our total itemized deductions up to $13,200. The couple also likes to give back to their community by donating to the food bank each month. Let's call it $100, which brings our annual total up to $14,300. They only paid about $500 out of pocket for medical expenses, which means they cannot include that. Medical expenses paid out of pocket need to total at least 7.5% of their adjusted gross income in order to be deductible. In this case, 7.5% of $80,000 is $6,000. Even if the couple ended up incurring $6,000 out-of-pocket medical expenses, they would still only have a total of $20,300 worth of itemized expenses, meaning it would still make more sense for them to take the standard deduction, since it's almost $9,000 more than their itemized expenses. So unless you paid an absolute fortune in out-of-pocket medical expenses, or you pay a ton in interest on your home mortgage every month, or if you're extremely charitable, or you have a combination of several of those, for most taxpayers, it is beneficial to take the standard deduction. And to be honest, it's a heck of a lot easier. I, for one, have never been able to itemize, and I am certainly not mad about it. Thank you so much for tuning into today's episode. If you haven't already, please be sure to rate and review this podcast wherever you listen, and subscribe to Rich Girl's Guide on YouTube. Let us know in the comments if you're going to be taking the standard deduction or itemized this year. I will have a brand new episode out for you next Monday, so stay tuned for that. Till then, have an incredible and productive week. Later, Rich Girls.